Welcome to the Explainer. Look, I am absolutely thrilled you're here today because we are putting PDF Solutions, ticker symbol PDS, through an absolute gauntlet. We're not just looking at some run-of-the-mill earnings report. No, as an investment analyst, I really want to know how this company holds up when subjected to the ultimate financial stress test. So we are going to run this semiconductor data platform through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. And then we'll hit it with a rigorous discounted cash flow model and some peer comps. Okay, let's dive right into this.
All right, here is our roadmap for today. We've got our company snapshot, the Buffett lens, Lynch and Graham, our DCF valuation model, alternative valuations, and finally the synthesis and verdicts.
Section 1, Company Snapshot for PDF Solutions. Because, hey, before we can value it, we've got to understand exactly what they do.
Think of PDFs as the critical semantic data layer that literally makes AI actionable inside semiconductor manufacturing. In an industry dealing with microscopic precision, AI simply can't just guess. It absolutely needs physics-validated data. And PDFs, they provide that context engine right across the fab. And their financial momentum really reflects that utility. In Q1 2026, total revenue hit just north of $60 million. That is a massive 26% increase year over year. Non-GAAP net income came in at $12.6 million, or about 31 cents a share, backed up by a very healthy $246.4 million backlog. So the top-line growth is absolutely undeniable. But as analysts, we need to look a lot deeper. Section 2. The Warren Buffett lens, economic moats and owner earnings. The big question, does PDFS have a moat wide enough for the Oracle of Omaha? Well, qualitatively, Buffett would absolutely love this business. PDFs benefits from what we like to call the Switzerland effect. They are the neutral, completely vendor-agnostic data steward of the entire semiconductor industry. Their secure WISE platform is actually installed in 99% of 300mm fabs globally. 99%. Because they don't compete with the hardware OEMs, everyone just naturally trusts them to handle the most sensitive data flows in the world. It's essentially a structural monopoly that prevents fabs from replacing them without immense, and I mean immense, pain. That right there is a textbook economic moat. But what about the actual financials? Buffett cares deeply, deeply about owner earnings, which is basically free cash flow. And the crucial figure here is $2.6 million. That's our approximate Q1 owner earnings. How do we get there? We take that strong $12.6 million in net income, and we subtract the roughly $10 million in capital expenditures the company spent this quarter building out their e-probe systems. So Buffett's verdict? Unbelievable moat, great management, but that heavy CapEx dragging down owner earnings means he'd demand a much, much wider margin of safety on the stock price. Section 3. The Lynch and Graham lenses. Growth versus defense. So Peter Lynch wants to categorize the company. Is it a fast grower? Is it a stalwart? And he absolutely loves insider ownership. He is totally willing to pay for growth if the PEG ratio makes sense. Benjamin Graham, on the other hand, well, he's the father of value investing. He wants hard assets, steady earnings, stability, and a massive margin of safety. He strips away all the AI hype completely. Let's stress test the stock against both of these heavyweights. Looking at the ownership breakdown, Peter Lynch would definitely categorize PDFS as a fast grower, especially given that 26% revenue jump. And he'd be thrilled to see CEO John Kibarian holding over 6% of the company himself. But Lynch relies really heavily on the PEG ratio, price to earnings divided by growth. With a PE sitting around 49 and growth at 26%, our PEG ratio is roughly 1.88. Lynch usually wants that number well under 1. At 1.88, you are definitely paying a premium for that growth. So Lynch's verdict here, it's a solid hold. Okay, now let's strip away the growth narrative entirely. Benjamin Graham uses a very strict intrinsic value formula designed for defensive investors. It's the square root of 22.5 multiplied by earnings per share multiplied by book value per share. He wants to be absolutely certain you aren't overpaying for the underlying assets and current earnings. Let's actually step through this math together. If we annualize their Q1 non-GAAP EPS of 31 cents, we get roughly $1.24 for the year. Applying a book value per share of $7.02, we multiply 22.5 by 1.24 by 7.02. Take the square root of that whole shebang, and Graham's formula spits out an intrinsic value of exactly $13.99 per share. With the stock currently trading around $61, there was literally zero margin of safety here for a deep value investor. Graham wouldn't touch this stock at current levels. For him, it's a clear, definitive sell in his defensive framework. Section 4, the DCF valuation model. Let's forecast the future to try and price in the actual cash this company is going to generate. Here are the raw mechanics of our model. Step 1, we forecast the free cash flows for the next 5 to 10 years. We're explicitly assuming a 20% annual growth rate here, which aligns precisely with management's stated long-term targets from their earnings call. Step 2, we calculate the terminal value using a perpetual growth method. And step 3, we discount all of that future cash back to today using our weighted average cost of capital, or WACC.
Now, because DCF models are highly sensitive to your assumptions, we always run a sensitivity table. By varying our discount rate and our terminal growth, our base case, which is a 10% WACC and a 3% terminal growth rate, gives us a fair value of right around $52 per share. Remember, the current price is about $61, so even giving them full credit for executing perfectly on their 20% growth target, the stock is currently priced for absolute perfection.
Section 5. Alternative Valuations. Let's see how PDF Solutions actually stacks up against its industry peers. When it comes to top-line performance, PDFs is just drastically outperforming its peer group. They posted nearly 26% year-over-year revenue growth in Q1, while the competitor average was lagging down at 15.9%. This rapid expansion is exactly why the market is assigning them such a premium multiple. They are expanding their market share, which, by the way, currently sits at just under 0.5% of total industry revenues, so there's plenty of runway left for sure.
But let's look at how the market is actually pricing that growth. In our comparable company analysis, we have Applied Materials, a traditional semiconductor hardware giant, trading at a PE of about 25. On the totally opposite extreme, we have Cadence Design Systems, a premium electronic design automation SaaS company, trading at a massive 92 times earnings. PDFs, with its $2 billion market cap and 49 PE, is priced right smack in the middle. They aren't a pure hardware play, but because of that heavy eProbe CapEx we talked about, they aren't a pure 90+% gross margin SaaS play either. The pure multiple really suggests they're fairly valued for this unique hybrid model. Section 6, Synthesis and Final Verdict. All right, it is time to bring all of these analytical frameworks together for a final recommendation on PDF Solutions. We've officially run the gauntlet.
Synthesizing our models, the results are actually crystal clear. Buffett, he loves the moat, but passes on the price. Lynch rates it a hold because that 1.88 PEG is just a bit rich. Graham screams sell, seeing an intrinsic asset value of barely $14. Our forward-looking DCF lands at a $52 fair value, making it a hold. And peer comps suggest it's fairly priced right in the middle of the pack. The gauntlet reveals a strategically vital, incredible company, but a stock price that currently demands absolute perfection. So let's weigh this out. The qualitative strengths are undeniable, right? PDFS is the AI-resilient infrastructure of the semiconductor world. They own the physics-validated semantic layer, and their 99% monopoly with SecureWISE makes them a literal toll collector for fab-wide AI. But as analysts, we really must respect the quantitative risks. The valuation multiples are undeniably high, and the heavy capital expenditure required to scale their eProbe machines is a very real drag on free cash flow in the near term. Remember, great companies only make great investments at the right price. We see fair value hovering in the low $50 based on those future cash flows, while the defensive models demand a much lower entry point. PDF Solutions holds the keys to the AI semiconductor revolution, but the real question is, are you willing to pay a premium for those keys today? Calculate your own margin of safety, and we'll see you on the next explainer.